Hey guys, what's going on? It's Darren from the Stock Trading Couple, and today I'm here to talk to you about one key financial ratio every investor must know. So let's get right into it. This ratio is one of the most common ratios. You'll see it everywhere, and it's a favorite among investors for how to value a company. The end of that, of course, is the price to earnings ratio, or PE ratio, as it's more commonly known. So the best way to kind of explain how this stock or how this ratio is used and define it is it's basically just a formula, as you kind of can tell from the title, P over E. And so as you'll see on the screen here, the PE ratio equals market value per share over earnings per share. So of course the market value per share is common enough to find. You just go online onto Google, search what a stock is worth, and you can see it right there. For example, let's try to do Apple right now. So here we are on Google. Let's take a look for the numerator of this ratio. Now let's start with an easy one. A stock that everyone knows, Apple. So the Apple stock price, as you can see here, is 156.81. So that's our numerator. Let's go back to the formula and plug that in. 156.81. Okay, now how about the denominator, earnings per share? Now that's a little more complicated, but it's still pretty simple if you think about it. So the earnings per share is pretty much just how much the company earns per share. Now there's two different kinds of values you can put in this denominator, sometimes three, but we'll get into those later. The main one used is just the trailing 12-month earnings per share. And so that's how much money or earnings that the company has brought in per stock over the last 12 months. Pretty self-explanatory. So let's see where we can find the earnings per share. Now it's just also pretty simple to find the earnings per share. All you have to do is go on to Yahoo Finance. I like using Yahoo Finance. It's pretty easy, common, and it's got lots of information on there, what you're looking for. It's fast, quick, and easy. So here we go. Just right on the home page, we found Apple. And here it is, earnings per share, or EPS. TTM stands for trailing 12 months. So 5.61 is this value. Let's go plug that in right now. So there we go, 156.81 divided by 5.61, and that equals 27.95. Just like it's shown here on the page, 27.95. So yeah, this number's fine and dandy. We got 27.95. But what does that mean? Well, I'm about to tell you. So number one, the PE ratio just relates a company's share price to its earnings per share. We've talked about that. Now, what does it mean to have a high PE ratio, a low PE ratio? And what is a high PE ratio and a low PE ratio? Well, I guess it's all kind of relative. The best way to kind of determine a high and a low is to compare it to its industry average. So when we're looking at Apple, you would compare it to technologies. And if we're looking at a utility, for example, in Enbridge, you would compare it to the utility market. So a high PE ratio means it's overvalued or expecting high growth rates. Whereas a low PE ratio means it's undervalued. Now you can kind of just make sense of this by looking at the formula. Of course, a high PE ratio means that its stock's price is very high compared to how much earnings it's bringing in. Whereas a low PE ratio means its stock's price is very low compared to how much earnings it's bringing in. Now you'll see commonly in the tech industry has higher PE ratios than, for example, utilities. So why do investors like the PE ratio? Well, it helps you find those stocks that are undervalued. I'm sure you hear that term thrown around all the time, undervalued, overvalued. An undervalued stock is kind of seen that it has potential that no one else has realized. So what are a few other takeaways? Companies that have no earnings or are losing money do not have a PE ratio. So sometimes when you search a stock, you might be looking for its PE ratio, and it'll just be blank or a dash there. And that's because, like I said, there is no earnings or it's losing money. For example, Uber was in this category for a long time. And that's just simple math. If you remember from your high school math class, you can't put a zero or a negative value in the denominator. Now I have another fact for you here. The S&P 500, as we know, is the 500 biggest companies. It's a great way to track the market. Just to show you how much the PE ratio fluctuates. In 1917, it was at an all-time low, the PE ratio that is, at 5x. Now, in 2009, just before the financial crisis, it got to over 120x. So as you can see, valuing the PE ratio, you need to know what the industry you're in, what time of year it is, what time of the stock market is. It's always changing, and it's a relative term. So now that you know all about the PE ratio, what it means, how it's formulated, and some examples, let's look into some stocks and what their PE ratios are. So my favorite website to look for PE ratios of companies is called Wall Street Zen. So Wall Street Zen has a really nicely laid out website, and it's easy to look for the PE ratio and compare it to companies and other industry averages, and it lays it out nicely in an easy to quantify chart. So let's look at some technology sector. Actually, you know what? I'm going to change my mind. Let's look at some automotive sector companies. So first, let's try looking at Ford. I'm sure a company you all know very well. So right here you can see their stock price. Of course, every website has this, but it gives some good information on the valuation. It kind of gives a score, how their valuation is, and it compares it to the market averages. So if you scroll down here, you can see their price to earnings right there. So on the bottom, Legend here, the company, that's their PE ratio. So currently it sits at 27.43. The orange line is the industry, and so that would be all automotive companies in the industry, and the blue line is the market, just the overall stock market. So as you can see, Ford looks to me like to be a good value. It's generally, except for this spike here, always under the industry average. Same with the market average. So let's look at one more company here. Let's look at Honda, another pretty well-known automotive company. So as you remember, Ford's PE ratio was 27.95. Honda's is 6.23. So Ford was a good value. Honda's even better value. As you can see here, a similar industry average, of course, because it's still in the automotive industry. Same market average, but a very low PE ratio for the company at 6.23. Now, another company in the automotive industry that I'm all sure that you guys have heard tons about, Tesla. And you probably know why I'm picking this one here. Tesla's notoriously overvalued. So if we go down here, it has a stock price of $1,081 and a PE ratio of 304.77. Honda's was 6, Ford's was 27. This is 304. So if we scroll down here a little bit farther, you can see their price to earnings. Now, compared to the industry and compared to the market, it's just blows it away. And like we were talking before, this is primarily because investors expect high growth rates. Or some investors may think that this also means that it's overvalued. Also, just to kind of finish off on Wall Street Zen here, you can see all the other good information it has. Price to earnings growth. Obviously, it says here for valuing profitable companies with growth potential. We'll talk about that at another video, perhaps. But there's lots of other great information on here. It's a really good website if you want to become a value investor or are a value investor already. Let's look at one more just to compare. Let's try Apple, my favorite example. So again, PE ratio 27.66, as we talked about before, and let's see how it compares. So an industry average of 26.91, it's kind of just over that industry average at 27.66, and the market, it is below currently. One more just for fun. Let's look at a utility. So Enbridge, an oil and gas company, they supply mainly the infrastructure for oil and gas lines. Their PE ratio is 16.97, less than the other ones that we were looking at. And as you can see, the industry average is 24.23, which is also less than the automotive and tech industries we were looking at. You can see that this right now looks like to be a good value. But of course, a good value doesn't always mean that the stock's going to go up. It's just a metric that you can use to judge and make your own opinion. And that's all I got for you guys today. I hope you enjoyed the video and maybe learned a thing or two. Please like, comment on the video, and subscribe to our channel, The Stock Trading Couple. Have a great day.